Good morning, everyone. Here we are one more time, right in front of our beautiful Miami skyline, Marlene Gonzalez with Canvas Real Estate. And today I have the honor of welcoming Austin Palacios from First Origin Mortgage Lenders that is going to do a presentation of what it takes to qualify a first-time buyer. Even though first-time buyers could just be pretty much everybody, right,
They
Austin?
can be. They can be. We'll go into that as soon as we start the presentation. I got a little segment on that as well.
Perfect. Okay, great. So we're gonna go ahead and share the screen here and get the class rolling. And if you have any questions, please chime in or send us a quick little chat, okay? There you go.
All right. I hope everybody's having a fantastic morning so far. I am surrounded by some beautiful people around me right now, and it's a great day to have a good day, right?
Definitely.
All right. So first time buyer seminar. All right. Little table of contents here. We're gonna have the first slide is about us. This second slide will be common myths. There are several of those, but we broke it down to a few more common ones. Third slide is saving you time. Time is money. 4 is products available. 5 is loan process timeline. 6, contact us. And 7, any questions you have, go ahead and chat us at the end, okay? So about us, right? We've been open since 2006. Been in business for about 17 years. Our CEO has been doing this for over 20. You know, he's had several different companies also. So it's not like we're a little mom and pop shop. We've been doing this for many, many years. We are licensed in Florida, Georgia, and Louisiana. And the coming years will be into the Carolinas and the Midwest. So we're growing and growing, you know, adding more people as we go and making more friends too, right? A big misconception, we are a lender, not just a mortgage broker, right? We do lend personally with our funds. Our team is highly experienced. We have team members who worked in banks before, high in the company, such as Ed Sanchez, Christina Del Cabo. Those are two of our top producers. We have Manny Mortgage, Manny Perez, Miami Lakes native. He's awesome as well. And myself. We have very efficient processing staff. All of our staff is in-house. What does that mean? That means I could just walk into Dahlia, who is our head processor's office, and get something done for you right away. That's not something every company has the ability to say. And we're very blessed to be able to say that. We also have our own underwriting and our own handpicked appraisal panel. Why is that a positive thing? That is because we get to work with the appraisers hand in hand, working with them, trying to figure out why it was appraised in a certain way. Maybe we get them to budge or give us more information on why it was appraised a certain way too. And stuff like that, that's going to help better the loan in the future and make the process run a lot smoother than what it would be with another lender, right? Our senior management staff is very hands-on. What does that mean? We're very team oriented, right? So it's not just me working on your loan. It's going to be a few of us. It's going to be a team. You're not going to just have one, minded individual working on it. You're going to have me. You're going to have the CEO put his hand in it. You're going to have some of our senior loan officers put his or her hand in it. So that way you get different opinions and different things to help the loan process move a lot quicker. All right. And lastly, in this slide, we answer our phones. Communication is key. We're open 24/7. Telling you, if you call me, I promise you will get me and not a robot. I'll answer on holidays, weekends, day or night, 24/7. I've done pre-approvals myself at 2 a.m. I promise you, I get it done. It does not matter. And likewise for my coworkers also, okay? They get it done as well. We're the best in the business, and I'm blessed to say that every day. Sorry. All right, common myths, guys. There are several common myths out there, but I feel like these are the three that we've seen, that we come across almost on a daily basis that we have to explain to people that, these are essentially not true. And I'll add in a fourth one there at the end as well. Getting pre-approved is not needed until I find a home. Obviously, you guys know you guys don't want your time to be wasted. We need those pre-approvals to be done so you're not just out here wasting your time for these people who don't qualify for these homes. I mean, we know that these homes have gotten more expensive and the interest rates are up and stuff like that, right? So maybe 5 years ago, you could have bought a house with seller contribution and stuff like that for maybe 10 grand, 14 grand. But realistically, nowadays, for a single family property, you're going to be spending over 20 grand, and it's tough because people see 4 years ago, like, oh man, my cousin bought a house 4 years ago, and they only had 11 grand to buy the property. But things have changed, and we need those pre-approvals so you guys don't waste your time, right? Second common myth. This is my favorite right here. Your credit score needs to be at least 620. Now, that is a common misconception because banks usually tell you to have the higher credit score to qualify you, right? For us, our minimum is 580, and that is for FHA.
Can you repeat that again?
Our minimum credit score is 580, yes. And then also, if your credit is down, we work with you. We have this program called Credit Analyzer, right? And we could tell you how to better your credit if you need to be 580 or more, depending on what program you have. Okay. And then we also have an in-house credit guy, that is a little side piece that you work with him one-on-one and he betters your credit, your client's credit. Right. So third common myth, you must save at least 20% down for the down payment. So obviously that's not real, right? FHA, as we all know, is 3.5%. And we actually even have a conventional loan that's actually 1% down. So remember, guys, it's not 20%. It's never 20%. Okay.
Conventional loan, 1%?
There is conventional loans 1%. Do they qualify a lot in South Florida? I'm gonna be honest with you, no, because there's restrictions. But in Central Florida and Upper Florida, yes. And Georgia and Louisiana as well. That is actually a great loan, and I try to get as much as I can into that 1% conventional loan because nobody has heard of that. That's like, oh my God, what is that? It's like an alien come down from outer space. But no, it's an actual real thing. We close them all the time for people up north. So it just has some restrictions here and there, and we handle that stuff. That's not for you guys. That's just something to help your buyers be a little excited for you guys too. You can tell them like, oh, my lender has a 1% down loan, and you send them to us, and then we work with them and try to get them that 1% down loan. So the fourth common myth, guys. First-time home buyers are actual first-time home buyers.
I wonder why they call it that, huh?
Dude, I can't even tell you. I really can't. Because if you haven't purchased a property in 3 years, you are considered a first-time home buyer, right? Yes. So that means hometown heroes, if you haven't had a property in 3 years, you can do that. You can do FHA, you can do whatever other, down payment assistance programs that, some of them need the first-time home buyer requirement. If you haven't owned a property in 3 years, you're a first-time home buyer, right? That's an awesome myth too that we just debunked right there. All right, saving you time. Guys, I know you guys' time is valuable and I love you guys. So I wouldn't want you guys to waste your time. Time is money. It's the famous saying, guys. And I know people like to waste your time because they want to see the houses, they want to be amazed and stuff like that, but they're not pre-approved and they can't afford the house, and that sucks because you just wasted your time. You got all excited because you're thinking you're going to get under contract in a couple weeks. And the fact is you can't even afford the house. So you showed them the house for nothing.
And you know something? I don't know if our agents have run across this, but in broker remarks in the MLS,
Mhm.
more and more I'm seeing that they will not allow you to show the home unless you provide proof of funds if it's cash,
Mhm.
or the approval letter or pre-qualification letter,
Yeah.
which I don't know how they get away with it, but I've been seeing that they will not show the property unless they submit that ahead of
Yeah,
time.
and that's a blessing. That's a blessing because if we can make that standard, that means none of your time would be wasted ever, you know. So saving you time, knowing if your client is a first-time home buyer. Like I just said, if you haven't purchased a property within 3 years, you are also a first-time home buyer, and they would qualify for different types of loan programs. And those programs are made in a way to get you in the house easier than other programs. So that's awesome. That's an awesome thing to have. And lastly here, let us do the work. Let us do the work. We do all the work for you. Follow-ups for financials, right? Getting the documents together. And then also we're gonna work as a team together too, because we have to be in communications about what about what the client wants for this situation. And each situation is different. Each buyer has different needs. So we have to work as a team, but most of all, let us do the work, whether it be open houses, we'll be there with you. If you need us there for appraisals, we'll be there for you. Closings, we're gonna be there to educate your buyer. We're gonna be there for whatever. If they need a charger at 2 a.m., I'll go drive to their house and give them a charger too. It doesn't matter. Okay. It does not matter. Let's do the work. Let's get you the pre-approval, and we'll tell you what they can afford. All right, our loan products, right? So these are just some of our regular loan products, our most popular ones, really. So we start off with FHA, our favorite, right? You got 3.5% down, no first-time homeowner requirements. That's awesome, right? Several down payment assistance programs, and we also have community programs that fit into that as well, right? And then our minimum credit score, like we talked about earlier, 580, which is a blessing as well.
What is restrictions apply to 3%? Can you clarify that?
Okay, so and this is Ray Palacios. So that is for lender credits. So we actually have the ability to give lender credits on FHA for first-time home buyer credits. So it's up to a 3% limit. So we can't give more than 3% of the purchase or of the loan amount.
Right, but in FHA, the seller can contribute up to 6%, right?
Correct. And it will be a cumulative of 6% total.
Oh,
So if we give 3, then they would only give 3. If they're giving 6, then we can use our credit to lower the interest rate instead.
to do a buy down.
Correct. Yeah.
Interesting.
So and then the biggest thing about FHA is there is a common misconception that you have to be a first-time home buyer to get an FHA loan, which is not true. It just has to be your primary residence. So whatever you are buying has to be the house that you are going to live in for at least 12 months.
Let me tell you, that's thinking outside the box, in my opinion, because typically we as realtors look for credits from the seller when a buyer doesn't have all the money to be able to afford.
Correct.
Maybe they have saved that down payment, but maybe they're short on the closing costs.
Yeah.
So it could potentially, I'm not saying that we're gonna ask you for a 3% credit every single time.
Right.
But that's another way to go around it, because a lot of times the seller will not want to
Of course.
give up to 6%. Maybe they're only willing to give 2% or something like that. So if the numbers are tight, that's something we can sit down with First Origin mortgage lenders
Correct.
and try to go ahead and see if we can work it out. The idea is for that client to buy, and a happy client will refer more clients to you later.
Absolutely.
Yeah, and that 3% is going to be determined by credit score and the strength of the file. That's how FHA gives us extra margin to be able to give that back. So another FHA misconception is that you can only have one FHA loan. There are some limited exceptions for multiple FHA loans. We're actually doing a couple now where 2 years ago buyers bought in Lehigh County or over in Lehigh, and they were actually working here. Now they want to move back here. As long as the new property is 100 miles or more away from the current FHA loan property, that is one exception to get a second FHA loan.
How many miles? 100
100
miles.
miles, yeah. So
So in the Keys, we could go by, no, not in the Keys, but in Key West.
and then I know on FHA loans, they don't have rate hits for duplexes and multifamily up to 4 units. So that flyer that we put out in your messages over the weekend or late last week were FHA loans. On a duplex, it's still 6.625 interest rate and 3.5% down payment for a duplex or a triplex or a quadplex. So that does not change on the FHA side, and they don't give us rate hits. And for each additional unit, the minimum or the maximum loan amount for FHA goes up. So if you are buying a fourplex and you want to just do 3.5% down, or let's say 5% or 10%, if they want to put a little bit extra, then that fourplex right now, the maximum loan amount is just a little over $1 million. I think it's like $1,050,000 or something like that. So for a 4-unit property, where if you purchase if you sell a quadplex for, like, let's say 1.2, and they just want to put 20% instead of doing 25 or 30% that the regular banks or regular conventional requires, they can do less with FHA. So the 2-unit is right around 700 or so, 700 or 800,000. So if there is a duplex, you can go up to $700,000 on the loan amount itself. The purchase price can be higher, and they can just put a down payment to get to that maximum loan amount. Yeah. And I can share those different loan amounts for the duplexes, for the multifamilies with you guys as well.
Okay, very well.
And then the key is definitely that 580 score minimum. Now the rates, once you start getting into the 500s, the rates tend to not be so pretty, obviously, because it is a 580 score for a reason. We have pretty much people that we use for credit repair that are on hand, that will start using. We have the best available resources for credit repair that will repair your credit within 45 days. So, our system right away will tell me, number one, it's a credit analyzer. So as soon as I run any credit, whether it's a soft pull or a hard pull credit, it's going to tell me what your buyer can do to raise it 10 points, 20 points, whatnot. Maybe it's just paying down some credit cards to go up 20 points. So if they're a 560 and we need to get them to a 580, we can do something like that. Or if they just have a lot of collection accounts or some judgments or something, then we'll send them to our credit experts, where they can, we've had people go from a 580 to a 700 in 45 days. It is possible.
You mentioned a soft pull, hard pull. Can you explain the difference between that, and how does your company handle that?
Okay, so we take the added expense of doing a soft pull at the beginning. So our first pull is always going to be a soft pull. So that way your client is not getting phone calls from a lot of different banks and lenders, because these credit bureaus tend to sell the trigger leads as soon as any bank or lender does a hard pull on a credit. So our soft pull at the beginning will give us a credit score, will give us all their balances, will give us everything that we need, that we see on a hard pull, but it will not go as an inquiry on their credit.
Okay.
And we accrue that cost. So we do that soft pull, and then we opt them out of receiving any trigger leads from the bureaus. And then from that, the time that we do all that stuff to the time that you actually get them the house, a week later, 2 weeks later, whatever the case might be, then at that point we'll do the hard pull. And if they needed to fix anything from here to a month, that hard pull will get better if they paid down whatever credit cards we let you know about.
Okay, very well.
So no, go ahead.
Yes, FHA, amazing product as well.
VA loans.
Oh yeah, that's what we were just on. Yeah, FHA is awesome, guys. That obviously that 100-mile thing is amazing too. Then you have 2 FHA loans and you're better off, right? All right, moving on. We have the VA loan. Those are pretty standard, all around, up to 100% financing, right? That means we finance the whole loan entirely, right? Now we have no monthly mortgage insurance, saving them money. Mortgage insurance is an added cost towards the loan. No prepayment penalties, right? That means if they were to pay back or pay out the loan, right? There's no penalty, there would be no fee. Seller contributions allowed. That means the seller would be allowed to contribute towards the VA loan.
Up to the 6%?
On the VA side, it's up to 3%.
Up to 3%,
Yeah.
okay.
They follow more conventional guidelines. But either way, there are limits to what everybody can charge,
Okay,
including title companies and everything like that. So in a lot of cases, the 3% should cover all of their closing costs. If you can get them 3%, then they're essentially having 100% financing on everything, closing costs and all.
right. And what's that VA interest rate reduction refinance loan? Care to explain?
Okay, so that is more, that's on a refinance more than anything else. So if you currently have a VA loan, you can do a VA to a VA to reduce your
Interest rate.
your interest rate and all closing costs included, everything's in there. So a VIRRL is what we call it, but yeah, so 100% financing, no PMI, the no mortgage insurance. So if you have anybody that served in the military at all, which is actually very common down here because we have the Southern Command in Doral. So we do
Homestead Air Force Base.
yeah,
One in Keys too.
yeah, and the reserve base in North Miami.
Yeah.
So-
Interesting fact. Do you know that on a yearly basis, over 400 families relocate in and out of South Florida that belong to the military?
Yeah.
So we don't have a military specialist at the Miami Lakes office. Maybe someone should look into that, right?
Yeah, and there are newsletters that go out from for these military families. I don't know what it's called off the top of my head or anything like that, but I mean, if you did some research, I know that a few years back we advertised in it. But then we just got so swamped that we had so much business coming in that we stopped advertising. But I know that there is a newsletter that goes out to the VA families that go in and out from South Florida and throughout the entire state.
Are those
So-
loans like difficult? The appraisers are different?
No,
Is there
not at all.
any challenge?
So VA loans and FHA loans are probably going to be similar. If you have and to some extent conventional too, because if you have an exposed outlet that's considered a hazard, all the appraisers are gonna point it out. They tend not to, because these are our appraisers, so they try to look the other way sometimes. On the FHA and VA stuff, if there's a side view of the house and you can tell that there's peeling paint on the photo, then yeah, you'll probably have to repaint it or something
Yeah.
like that. But generally, or like some missing wood on fascia, things like that, they will tell you something. Or if the last one I had, which is probably over a year ago, I mean, we don't have too many issues with our appraisers doing appraisal loans for either of these. But there was a room photo where there was no ceiling fan, no light fixture, nothing, and there's exposed wiring from the ceiling. So and all it is just having them patch it up, at least put a cover on it, and then we pay for them to go back out there and just retake the photo, and it should be fine. So
your in-house or your preferred appraisers
yeah,
look out for these things because they don't want to kill the deal,
right,
in other words.
right,
Okay.
Absolutely.
But all of those things are fixable, and we just send them out a day or two before closing. So sometimes the AC, and even on the conventional side, sometimes the AC is not functioning. We've actually had some appraisals where the seller just put an AC unit there that's not connected to anything, or no power, no nothing. And if they see that, because maybe it was stolen or whatnot, they'll usually say something, and then it'll be hooked up and done a day or two before closing, and then we have sent out the appraisers even up to the day of closing in the morning, and then you do your closing in the afternoon. So we'll make it and it depends on the case, but a lot of times we'll make it a prior to funding condition instead of delaying your clear to close. So
All right, awesome. All right, so now we got foreign national loans. This is one of our bread and butter programs, okay? I myself have closed from Spain, Canada, and Peru, right? And there's several countries that, allow this program, allow us to partake in this program, right? So the minimum down payment is 30%. A lot of banks will offer 35%, 40%, because it's a higher risk loan to other banks, right? We love these guys. We want them to come, right? We want them to get the property here. We want them to have a nice life here in the States, right? So we're willing to help them out and do 30%, right? So all we need is an accounting letter, and there's no US credit required. That's a common myth for foreign national loans.
Amazing.
Yes,
Yeah.
that's awesome. These are the harder loans to close for a lot of lenders and banks. And we get them closed, right? All the time, pretty frequently. We just had a boom in December where we got a huge influx from Spain. I had one from Nigeria. It was crazy. It was crazy. It was ridiculous. But man, we got them all closed, within 45 days.
That's because you work until 2 a.m. No, I'm just kidding.
I mean,
Holidays.
Holidays too, I got you. No worries. I got you. Now, this is the more normal stuff, the conventional loans, right? You have the 1% down payment available. We talked about that earlier. South Florida doesn't really qualify for that too much, but up north they do, right? Then you got the 1-year tax return, right? That's almost a non-QM, right? That's something that not a lot of banks offer because it is a riskier, loan to offer because you're only seeing 1 year of their income of their tax returns, right? Instead of, an average of 2, what it would usually be. So then for conventional loans, we also have down payment assistance, right? So we have community programs, and then we have $5,000 credits, and we have the Florida bond program for 10,000, right? And we have to play with the numbers on each case, and we get them qualified for whatever program they would like to be in, right? And then we have one-time closed construction loans, right? So you have the lot, we finance the lot into the loan, they do draws, pay interest only. And then it turns into a 30-year fixed at the end of it.
It could be for Lehigh, for example.
Yes,
Oh, yeah.
we've been doing a lot of them for Lehigh,
Okay.
and because that's an up and coming place, people are loving to build there. Land is cheap over there, and that's a good spot to be.
So what you're saying is, in a conventional loan in this scenario, they can buy the land to build, like if it were a construction loan, and then it turns into a 30-year fixed loan once the property is done
Yeah.
and they get construction draws. Oh,
Absolutely.
we have somebody in the house that is gonna be building, right, Carlos? Very soon. So that's something interesting to look into.
Yes. The only thing is the property has to be built within the year, right?
Not like a developer that in the state of Florida has up to 2 years to deliver
Yeah.
their product.
Yeah, it needs to be built within the year. Now we have a newer program that we just got pretty recently. Proud to say we do land loans now. A
Wow,
lot of people don't offer land loans.
no,
No.
We do.
none whatsoever, first time.
No.
Exactly.
It's
Loan
different.
minimum 225,000 and it's 50% loan to value. And it's a blessing because now I can't turn away these clients now. I get to accept them because we get questions all the time. Oh, do you do land loans? Oh, do you do land loans? Right?
Right.
But now we do for multiple acres too, like big lots of land, 225,000 up.
One idea for these land loans, and we just recently got this product about 30 or 60 days ago. We will finance the actual land if they're not ready to build on it yet, and then we can use whatever 50% equity on that land for the construction loan down payment as well.
Yeah.
So we can do the construction loan after and then refinance everything into one.
Yeah.
So now the land loans, it's not bank statements, it's not like a non-QM product, so it does have to be a full doc kind of product. So they have to qualify for it. But when you're doing land loans, you don't have to get insurance. Like a property, or the property insurance, I should say, is very, very cheap. The taxes are going to be very, very cheap. So it's a little bit easier to qualify for. So.
Yeah, that's a good one, right?
You know,
That's a
yeah.
good one. That's a good one.
And I think we're one of the only lenders doing land loans right now. I want to say.
Yeah.
So.
Interesting. Non-QM, can you explain what non-QM is in layman's terms,
Like the
please?
actual word.
I don't know.
So non-QM stands for non-qualifying mortgage, which is non-government insured. So FHA, VA, conventional loans are typically some kind of government agency that insures those loans. Non-QMs are more private type loans. That's where you have your 12 months of bank statements, which is very, very common right now. I think 1 out of every 3 loans we're doing right now is bank statement for 12 months. So if you have a business owner that maybe they take in $400,000 in deposits per year, and at the end of the year they have cost of goods sold, they have expenses and all that stuff. At the end of the year, they're only their net income is $50,000, $60,000, $70,000. They want to buy a $600,000 house. Obviously, they're not going to qualify with $60,000, $70,000 of net income. What we do is we'll take their 12 months of bank statements. We'll add up the deposits, the true deposits for the company, not any transfers from their personal, but it has to be true deposits for the company. And if their company is making 400,000, you're guesstimated it's going to be about $35,000, $36,000 per month. And then we will take an expense factor as low as 25%.
Wow.
So yeah,
And the
but
interest rate?
so those interest rates, we're doing one right now at 7.375.
Oh,
They're actually not too bad.
Yeah, they're not
That
too
would be a good job for real estate agent.
Yeah, they typically start in the high sevens. So that's 7.3 that we're literally closing next week. I believe you have to pay like 1.5 points or like 1.6 or something like that to buy that rate down to 7.3. But they are in the sevens.
But that's what would be good for us.
Yeah.
you know?
Yeah,
For realtor,
for
right?
realtors, correct. Yes,
That's a
yes.
good product for us.
Yeah, it's actually one of the things I do recommend if you are a real estate agent is to at least, and I know your brokers recommend this as well, is do your own PA.
Yeah.
So that way all your commission checks are going into that PA account.
Yeah.
Or an LLC or something like that. So into an actual corporate account where it gets you guys a little bit more organized with your expenses and all that stuff. I highly recommend that. And for these loans, it's much better for me to show one account with all your deposits going in there, all your commissions,
Yeah,
and whatever else you do, any real estate consultations or presentations, and
management.
maybe they pay you to speak at a function. I don't know, but everything going into that PA account, we'll basically look at it as a business income, right? Whereas as opposed to just everything going into your personal account, and then it's hard for us to decipher what's business and what's personal.
Yeah.
Of course.
So,
Now, in a scenario like that, what is the typical down payment?
so on the bank statement loans, we can actually do it up to 90% loan to value, so 10% down right now. It actually went down to 80% loan to value, but it recently came back up within the last couple of months. So we can do 10% down with those bank statement loans.
And that's 12 months.
12 months of bank statements, yes.
Okay.
Yeah. In our non-QM space though, we also have the private lending, which is our hard money stuff. Hard money, typically we do want at least 45% minimum down payment. And it's basically no questions asked. We don't do an appraisal. We don't do anything. My investors they're private citizens that have a few $1 million each that they're willing to lend. And your interest rates are going to be 11, 12% on average. We are a little, and nowadays a lot of lenders out there on that private money or hard money space, they're going to 14 and 15% interest rates because the conventionals are 7 and 8s. So being in the 12% range is too close to the conventional. So they're all going up to 14, 15. We are still between 11 and 12.
And how much is more or less the origination points? Like,
That's one of the, so we'll do between 2 and 3 points, whereas other lenders are 4, 5, 6 points.
On that type of loan.
Yeah. We're not looking to make a whole lot of money on those loans. We're looking for, personally, we want that loan to be a Band-Aid for a couple of years, and then we want to refinance them into a nice, prettier product.
Traditional.
Yeah.
penalties for prepayment?
So generally, those are 12 months of prepayment penalty.
12 months?
12
Yeah.
months, yeah.
That you have to have at least a minimum of 12 months.
Yeah, these and there are lenders out there that'll do 2 and 3 years of prepayment. So they'll give you a 3-year, 36-month private loan, and then they'll want a prepayment penalty throughout the whole 3 years. Our investors just want to make sure that they get 12 months of of interest for moving their money. That's pretty much the thing. But where we differ is other lenders might do an appraisal to see the inside of the house, to see if it at least has a kitchen, stuff like that. We will not do an appraisal.
Do they give, the rehab costs as well? They will lend the rehab costs?
No rehab costs on that. So if you do have a property that needs, let's say, a kitchen,
Fix and flip, yeah.
right? Oh, for the fix and flips. Well, for the fix and flips, they won't do rehab costs because that's generally, you know, and we can talk about it because maybe that's where we can do the 40% down. And then they'll have the extra 10% that they would be going somewhere else with to actually rehab it instead.
Okay,
But and it would depend on what the rehabs are, because maybe we can find them a nice prettier product to get in there for the 5-6 months, you know.
perfect.
Go back to the FHA renovation loan, because it's not on there.
Right, because on the I was gonna say on the rehabs on FHA. So if you do have a first time home buyer or somebody that's gonna live in this property and it does need a kitchen. So let's say that you go in there, there's no kitchen cabinets. We have 203K options for FHA loans where it's 3.5% down. And FHA will give you an extra up to $35,000 on top of what your purchase price is to actually put the kitchen in there. And for that, you don't necessarily need some kind of contractor. However, you can go to Lowe's, get an estimate from Lowe's or Home Depot on a new kitchen and kitchen cabinets in their little resource center there. And we will use that estimate and we will pay Home Depot for the kitchen cabinets. So if you have one of these larger kitchen manufacturers or something like that, and they give us the specs and everything for the manufacturing of that kitchen, we can finance that in there.
And the
Up to
interest will be
35.
the same for that, extra 35K?
Generally, that product is about 0.5%, and that's regulated by FHA, but it's about 0.5% higher than the normal FHA rate.
Okay.
So if their rate would be 6.75, for instance, then and you're doing a 203K and we're giving you the extra, then it'll be like 7.25.
For the whole amount or just
For the whole thing, for the entire
loan?
thing, yeah.
Okay.
Yeah, because it'll be held in escrow until it's done, and then they give you the check
That's
after.
a really good route for
Oh, yeah.
first time home buyer that needs to do repairs in their
Absolutely.
homes. And
Right.
usually Miami, most
Yeah.
of them, they will
They
need
need it.
to do. They need it.
Well, a couple of them that we actually did recently, because we are having a roof issue in South Florida or
Yeah.
in all of Florida. If the roof has a 0 life expectancy, then you know we'll get you an insurance with a builder's cure or whatever
Yes.
insurance, and then we'll do a 203K to replace the roof.
That's amazing.
Yeah. Yeah.
DSCR, we gotta learn all these acronyms.
So I don't know if you want to touch up on DSCR or do you want me to?
Nah, go ahead.
So
Hit 'em.
DSCR is for debt service. Basically with a 680 score and 20% down, we are going to look at that property. It's going to be an investment. We're going to look at it as an investment property, 20% down, 680 score. And as long as the payment or the rental value of that property exceeds the full payment amount, it debt services. So for instance, if you're purchasing a $600,000 house, 20% down is 120 grand. We're financing 480. Your payment with everything, and there's no PMI, obviously. On none of these QM loans, by the way, there is any PMI. Even on the bank statement loans, 10% down. I wanted to add that. So there is no PMI with 10% down bank statement. So that is another bonus to 10% down non-QM. Right. So the interest is a little bit higher, but you have no PMI. So on the DSCR, you got 20% down anyway. There's no PMI regardless. But let's say $600,000 house, you put 120,000 down, 20% down. We're financing 480. Your payment's going to be, let's say worst case scenario, $4,400. And the rental value is $4,500. Then you debt service. So if my appraiser comes back and says you can rent this house at $4,500, and your payment is $4,400, then we move forward. We order title and we go to closing.
Any cash,
Yeah.
it doesn't need to be
No.
any percentage, just
Yeah.
100, 200 more monthly.
Yep.
And it's with 25%,
20%.
20%.
Yeah.
And
And-
no, PMI.
And no PMI.
That is 20%.
Yeah, it's 20% down, no PMI. So touching back on the bank statements, if you do a 90%, so 10% down on a 12-month bank statement program,
Mhm.
you will not have PMI. So this one that we are closing next week, 7.375, because he bought it down. Let's say his regular rate would have been 7.875. He would not have had any PMI.
Did you have a question about PMIs? No. Yes, can you give us just a quick rundown? What is PMI? We gotta learn all these acronyms.
So PMI is property, it's mortgage insurance, property mortgage insurance. It is paid monthly. Every FHA loan will have it.
For the life of the loan.
Okay, so yes, for the life of the loan, if they put less than 10% down, if you get an FHA loan and you are financing less than 90 or so 90% or less, so 10% down or more, then it will be on there for 11 years. Otherwise, if you do regular 3.5% down, it will be on there for the life of the loan. So that mortgage insurance on the FHA side is 0.55% of the loan amount. So if you're financing 300,000, your PMI is roughly going to be about $160 a month.
Sorry.
It's 0.55%. So that one's standard on FHA. And FHA will charge a 1.75% upfront mortgage insurance, which we finance it into the loan as well.
No, you add
But at
the
least,
amount.
right, we just add it to the loan amount and they don't have to pay it out of pocket.
You're paying that
Right.
extra
So,
down.
yeah. Now, conventional, if you do less than 20% down, then you will have, depending on that's going to be dependent on credit score for the most part. If you have a super high credit score, 740 or something like that, generally speaking, your PMI is probably going to be around that FHA half a percent range. So if you're financing 600,000, your PMI monthly is going to be about $300. So if your score is lower, let's say you are a 660 score, then that PMI tends to be a little bit higher on the conventional side. It could be as much as, close to 1% or, 0.8 or something like that. At that point, the rule of thumb for us is if you're below a 680 score and if you're between a conventional loan and an FHA loan, it will be a lot cheaper for your client to do an FHA loan because if they have a 660 score, 670 score, their PMI on FHA is going to be 0.55, regardless of score. But on the conventional side, it might be 0.89.
Exactly.
So
More
so we're actually, and the rate will actually be lower on the FHA than conventional because the lower the score on conventional, the higher your rate is going to go. So you're going to be in the 7s, whereas an FHA with a 660 or 670 score, you might still be at 6.99. So on the FHA side, apples to apples, same loan, your payment will probably be a couple $100 cheaper. So that's why we can't be afraid of FHA, because these FHA borrowers will qualify for conventional loans. There's nothing wrong with them. It's just in some cases it might be a better product for the borrower. And if I can save somebody $100 or $200 a month, I'm going to put them in that, and they will have more buying power on the FHA side. So, now debt to income is a big thing on all of these loans. For the most part, non-QM, conventional, foreign nationals, all of those guys, the debt to income ratios cannot exceed 50%. So if you take the car payments, all their payments, and let's say everything combined is going to be $4,000, then they need to make $8,000 to qualify for $8,000 a month to qualify for those $4,000 in payments totally. On the FHA side, we can actually go to 57%. So it also gives us a little bit more purchasing power. So a lot of times when you send me a borrower and he's looking for a $500,000 loan or a $500,000 home, I might tell you, listen, if it's a single family home, we can take him FHA and he'll qualify for 500. But if it's a conventional or a condo where they have association and stuff like that, obviously my debt to income is 50% maximum, and then they might qualify for 450. So that could be a determining factor as well. What else? And then we do go up to the 50% on conventional loans. A lot of banks, so if they were to go to Chase or Citi or Bank of America, they stop at 45. And then on the FHA loans, they stop at 50. On conventional, we go all the way to 50, and on FHA, we go to 56.99. So,
These guys give us more.
I know, that's, yeah.
right. So if they did go to a bank and they got approved for 500, maybe we can approve them for 550 because we can go a little bit extra on these debt to income ratios. And there are a lot of things that we can do that banks won't. And you know, I used to work at Bank of America. Once that client is with Bank of America or Citibank or any of these other banks, and they submit something erroneously, and maybe it was a small mistake, and they didn't even mean to submit it. The banks will take it. I mean, they're looking for fraud all the time, and so are we. But they can take a misconception out of hand, and then all of a sudden your deal is dead. Whereas we can take a look at it and say, wait a second, but this is not theirs, you know, and we can try to explain it. And it's our underwriters, and it's a little bit more common sense underwriting. Like, you know, why are you doing this? Okay, stop doing this. Give me a letter that you canceled it, and then we move on, you know. Whereas these banks might not be so lenient on that. Their underwriters are just looking to kill deals left and right. So. All right, so we went over non-QMs, DSCRs, private. We're moving on
A
to
point we do need to add on DSCR, we do have investors that will go 1-to-1, private investors that will go 1-to-1 on the rental value. Okay, instead of having to.
Yeah.
10% more or something.
Right, yeah. So instead of that 4,400 to 4,500 scenario that I told you about, yeah, if it's 4,400 and 4,400, if they match, yeah, generally those are with a 30% down payment instead of the 20 or 25. So.
That's easy. Okay.
Yep.
Actually, I'm sorry. You know what? With the 30%, and because this was a meeting that I just had 2 days ago, they can probably even go below the 1-to-1. They can go to 0.9. So even if your payment is 4,400 and your rental value might be 4,200, we can still do it with that 30% down. So we actually will look at those products as well.
Okay.
So it's going to be strength of file, but we can probably go to 0.9 or 0.8 of that rental value.
Yep. Now we have commercial loans. Ray, our CEO, closes about 5 or 6 commercial loans a year, and he's the top dog when it comes to commercial, guys. He's the top dog. So if you ever need any questions, this is the man to ask right here. We have SBA loan options as little as 10% down, and we do all property types, okay, for these commercial loans. What was the down payment we said for the commercial loans now from what it was before?
Okay, well, it used to be 15 or 20%, but we can actually do multifamily. Obviously, multifamily is not going to fall into the SBA loan product, but we can do. We're doing one now where it's an 8-unit property for a couple $1 million with 25% down. So on a multi-unit, we can go as little as 25% down.
And it used to be 30, right? And we just had that meeting the other day.
Yeah,
20% for multifamily
25
above 4 units. okay?
above 4 units. Yes.
Okay.
Yeah. So anything 1 to 4 unit is residential. And then 5 units or higher is multifamily.
That's a plus because these other lenders are still in the past telling you, oh, you need 30, oh, you need 35. We're out here, 25%. So it's a lot better than other guys.
And what we can use the SBA loans for?
Okay, so the SBA loans is for a company going into or purchasing a property, and they're going to use it. 51% of that property is going to be for use. It's like the FHA loans of commercial. So they're gonna occupy for their actual office use. So right now, so if Canvas wanted to buy a building, as long as Canvas operates 51% or is going to operate 51% of that building, we can do an SBA loan. And what we do is we break it down into 2. So we actually lend 50% and SBA lends 40, and that's how we get to the 90. Those rates tend to be a little bit lower, and we can finance closing costs in there as well. So because there are attorney fees and whatnot on purchasing buildings, so we can include a lot of the closing costs in there. So really the 10% is it's minus some closing costs and stuff like that we can include. So
All right.
Okay, don't tell much.
Condo loans, guys. I know you guys have been getting a lot of condos because I've been getting a lot of calls on condos, right? Full doc and full review and what's the other term I'm
The
thinking of?
limited one. right?
Limited review,
Limited.
right, correct. So we have a list of approved condos that we have personally, and we update them every, few months, I would say. And
We need the
Eh,
list.
I can send it, I
that
can go
list.
ahead and send it to
We
you.
need
Please.
that list.
It will actually tell you limited or full review
Okay,
on each
Okay.
condo, right, and each association. And then if we do have a condo team, right? So if you do have a condo that is not on the list, we can take a look at it for you and we will tell you whether it's gonna be full review or limited review, okay? And we'll get that approved for you ASAP, you know?
Do you see more condos coming on that list as approved? Because after,
Yes, because they had the full year to work on the reserves and all that other stuff they needed to work on from
Will be
last year.
better.
Well,
This coming
what
years.
happens is, January 1st of 2025, a new law comes out in the state of Florida that requires every association with greater than, I believe, 3 stories, so anything higher than 3 floors, will have to have full reserves. And that is going to open up the condo market big time for us, for the realtors. So you'll be able to sell, and I'm hoping that FHA gets on board with this stuff too and starts approving more, but it is a little bit more expensive for them to get approved with FHA directly. But as for conventional loans, we can do it with as little as 3% down for a first-time home buyer and 5% down for a primary residence, for a non-first-time home buyer. But we are seeing a lot more of these condos already starting in 2024 to get the reserves.
Mhm.
And fully reserved means 10% of the budget.
10% of the budget, correct, yeah.
Okay.
So if their fee, their income from, let's say, all of the units is $100,000, then they would need $10,000 a month going to reserves. So,
And the gross income.
so basically, when you say condo with no reserve as little as 10%, is because you're gonna do a double loan?
no, well, yes, that is correct. So that is still on the conventional side. So what we do is we break it up and go around what Fannie Mae and Freddie Mac has in store for us. And we do one loan for 75%, and we do a second loan for 15 to get to the 90.
Exactly, but minimum 50K.
Minimum 50,000 on the second loan, yeah.
That's a good one.
Yeah, so a lot of, if they were to go to a Wells Fargo City or anything like that, they won't do that for you.
Yeah,
They don't-
get the 25%, but
Right.
that's not, you can go and you can get
Yes.
10%.
So instead of them requiring it on a limited review to have 25%, we do the 25, and then we have a lot of partnerships with credit unions and other banks, smaller regional banks that will do that 15% loan, minimum 50,000 for you. But I mean, if you're selling, and this is also for a jumbo loan too. We can do that on a jumbo loan.
That's a good one.
So if you have $1 million property, and well, I mean, $1 million is probably a little excessive, but if you have a probably $700,000 or $800,000 or $800,000 property, and they don't want to do 20% down for a jumbo loan, for instance, then you can do less, and we can give them a small second, which a lot of clients like because they can literally pay that off quickly. There's no prepayment penalty on those second loans, and they can reuse it as like a credit card. So they'll have that open. It's a HELOC that they'll have open that they'll be able to charge on over and over and over. So they can pay it off. They can, take it back up, whatever they want to do. So their payment will only be their first. I've personally done that for my properties where I've taken 2 loans, and instead of it being a jumbo, that way my first is only 600,000, and then I did a HELOC for 200, and then I paid off the HELOC, and I just have, the lower payment on the first loan, and that's it. Instead of having one big giant payment that I have to pay over 30 years. Yeah, but we do that on condos very, very often. Like, we're closing those every month.
Yeah, that's a
So-
good route for people that doesn't have the 25%.
Correct.
Yeah.
Correct. So, all right, so no reserve with the 10% down. We have the 20% down minimum for investments. There are banks that are asking you for 25 and 30% down for investment loans. So we are still at 20%. So, And then on those, at 620s, because that 10% down on those condos, 620 is the conventional. Technically you do need a 680 for us to do that second loan. But for condo loans in general, if they have the reserves or whatnot, we can do it with as little as 620 scores. Alright, so, and then jumbo loans.
Yeah, finish
I
it
guess,
up
I
with
guess we
jumbo.
jump into jumbos.
Yeah, finish it up.
So jumbos are up to 90%. Jumbos don't have PMI because they're non-conventional loans, they're non-conforming. So we can do them with as little as 10% down. The rate gets a lot prettier with 20% down. So at 80%, that's where those jumbo loans will be in the high sixes, low sevens, stuff like that. But we can do as little as 10% down. We can do up to 6 million, and in some certain cases, we can probably even go higher than the $6 million. So we kind of throw out that $6 million figure because you know we used to have that number higher, and then everybody's calling us about these $8-9 million loans, and they make 0 cents for us to do. So that's why we kind of put a limit at the 6 million. But if you do have a scenario with anything higher, just talk to us, and chances are we can probably do it. But
This is the starting value. ¿Dónde empiezan los jumbo loans?
so the conforming limit is right around 753, I want to say. So conventional is up to 753,000. Anything above that is considered a jumbo loan. Now remember, if you have, for instance, a $1 million house that you sold and they do 20% down, that 20% down is 800,000, and that's considered a jumbo loan. But if our pricing on the conventional gets them down into the sixes, and we do a second loan for the 50,000 to get them down to 750, that's we can do stuff like that as well. So we'll do a little tiny HELOC for the 50,000, and then get them a conventional loan with a nicer, prettier rate.
Because the interest rate is higher in the jumbo than the conventional loans?
It tends to be a little bit higher, yes. So if we can save them a little bit of money and it makes a little bit more sense, then we'll do that the little HELOC to get them down to the conventional loan limit.
Oh.
And then on those we typically can go to 85% loan to value on a cash out refinance. So that's it. And then we do have minimum 660 scores. However, rate gets a little uglier the lower that credit score goes on these bigger loans. But we like to see preferably 680 or higher. If they have anything lower than a 660, again, we have our credit people take a look at it. It might cost them a little bit to fix their credit in the 45 days, but it's going to save them a lot of money in the long run.
Okay.
Some of our agents here work with investors that have cash flow, but when we're talking about an investor, is it better for the investor to look for, I don't want to say a line of credit or something, so they pull funds from that as opposed to using their own funds? What's your take on that?
It's iffy. I mean, if they don't have the funds, obviously getting a second loan on their current properties helps. We're doing a couple of them now where we just literally closed one yesterday. So we are doing bank statement seconds. So we did a second loan up to $400,000, but it's a loan, it's not a HELOC, and we use their bank statement. So this was an accountant who had an accounting firm. She has $400,000 or $500,000 in deposits, but their net income is below the par, and we used her bank statements for her company to give her $300,000
Right,
as a second loan. So we didn't refinance her first, which had a 3.25 rate.
right. But I think my question, maybe I didn't phrase it correctly.
Okay.
Um,
That's a good one.
In other words, one of our agents here works with an investor who's
Right.
constantly buying inventory to fix and flip, but she's using her own income for that.
Yeah.
Are there programs for investors to be able to use the bank's money as opposed to their own?
Well, I mean, we can do seconds for investors also. So if you have an investment property that's free and clear, and I believe I had a scenario like this for one of you guys. So it's free and clear. I'm sorry, and they had a first mortgage on it. I believe for like $1 million or something like that. we are able to give them up to, so this, in second position, we have caps. So those loan amounts generally don't go above 400,000. That's kind of the rule of thumb. So we can give them 400,000 so that they can go and purchase another property or,
But that needs to be on clear properties or
no, it's the second loan, it's a second mortgage.
it's like a line of credit.
This is where I feel Ayala's brain working. So in this particular property, the one that I was explaining to you, so she wants to purchase an investment property. She took out 300,000. The investment property that she is gonna eventually fix and flip is going to cost her 550. So out of the 300,000 that we just gave her a second loan for, she's using 200,000 on another product that we're gonna give her a hard money on. So we're gonna do a hard money loan on that. She's gonna use the extra 100 or 50,000 or $70,000 to fix up the property. And then in about 6, 7, 8 months, she's gonna be reselling that property. So yeah, so you can use the equity on your house now, even with bank statements, to get access to some funds, and then use it for down payment on the next one. And that next one can be a DSCR. So if you're buying, let's say they take a line on the bank statement one, it's a hard loan, second loan. If they do full doc, then we can do a HELOC, but HELOCs we generally need it to be full doc. But we can do bank statements as a hard loan, and the rate is more or less in the 9s and 10s. But they can use those funds to maybe put 20% down and buy 2 more properties. So if you
And
get,
if they have, for example, an investment property that they have a loan for 300, but the
Mhm.
property value now is 550.
Yeah.
They can get that
yeah,
second
so
loan,
it's gonna generally be up to 80% loan to value.
no?
But yeah, let's say
80% of the equity,
80% of the house. So the house you said is worth how much? 500?
550,
So 550, and they owe 300,000 on the first.
yeah.
So 80% or 20.
250,
Yeah. So
Okay.
they'll have
and then you
250,000.
could do it with bank statements.
Right. Well, they'll generally have what, about $200,000, because so 80% of that 550, they'll be able to take out minus the 300.
Amazing product.
Yeah. So let's say they take out a loan for 150,000 and then they go and buy a $600,000 investment property and do 20% down because they have 150. 20% down is 120 plus your closing costs, and we can DSCR the new one.
Amazing. Okay.
So
Now you know where I was coming from, right? Okay, debt service
Yeah.
coverage, that,
just
is that
the rental
the,
values covers and
that,
yeah, or bank statements too. We can bank statement that loan also. But DSCR looks at just the property.
If we, todavía estamos en las otras preguntas, ¿verdad?
Yeah.
Bueno, yo he preguntado mucho.
I mean, listen,
It's okay.
I
no,
wanna
I
say-
love these questions because we're all learning in the process.
Because I think that when we start, we work a lot with FHA.
Yeah.
And we are in a market where FHA offers are a challenge.
Yeah.
Then maybe you can give us reason to put in our offers, our emails, our conversation with listing agents where we can support why FHA is a good one.
Okay, so generally speaking, as far as comparables, because the misconception, the common misconception is for appraisals.
Yes, that they will stand for 6 months.
For 4, actually. So we can reappraise it after 4 months. So it used to be 6 months, but after 4 months, we'll request a new appraisal.
Okay.
Um,
Can you request 2 appraisers during the transaction?
no.
Okay.
No, unfortunately, it has to be that is the only one that we cannot submit a second appraisal. So once we do an appraisal request and they tell me the value is, you sell a house for 500,000 and that appraisal comes in at 475, it's gonna be logged in for 4 months.
Okay.
At 475. We can do a rebuttal if you get me comparables and whatnot, and I can talk to the appraisers, say, hey, listen,
We can dispute it.
yes, we can dispute it,
Okay.
and we have won some disputes. Mainly if there was something that had recently closed and they didn't see it, they'll bump up the value. They'll use those comparables. But it has to be stuff that has closed within 90 days that we can use for a dispute. Aside from the minor repairs that an FHA appraisal or might request from you, like wood damaged on the roof or something like that. But I mean, it would have to be falling apart or like super peeling paint or something super hazardous. Aside from that, the standards are the same. It's the same three comparables. This, you know, and the other another three to just support listings and stuff like that. But the actual comparable portion is the same identical thing as conventional.
Yeah,
So
they used to come like very reasonable.
right. And then the other misconception was that these borrowers are worse than conventional borrowers. And they're really not. The problem is 5 to 10 years ago, these smaller mortgage broker shops didn't know how to pre-qualify people correctly. And that's where you get into trouble, where they were doing whatever they were doing to make these figures, you know, are what they are, and then they would get into the underwriting phase, and the underwriters would be like, where are you getting this income from? This person doesn't make 60,000, they only make 50, you know, 5,000 a month instead of 6,000 a month. So that's where we look at the docs. I'm a certified underwriter, so I train these guys to look at it with a fine-tooth comb, and we try to make it as foolproof as possible for our underwriters. So we do as much before we give that approval than during the underwriting phase. I don't remember. We haven't ever lost a deposit. When we give that approval and we get past those first 10 days of inspection period, there isn't a loan that we're not going to close. So we generally close every single thing. And actually, you know, knock on wood, we have a 0 default ratio. So every single one of our clients work where they say they work. Their income is what they say it is, and that's because we pre-approve them the way they're supposed to be pre-approved.
And continuing that same line, when we receive a client, because I know that we don't want to send you every client that calls, because,
Right.
you know, we may receive a few calls every day. What will be the questions that we should do as agent, like to look if it's a person that is
Mhm.
complete now,
Right.
or we need to prepare them? That also, I know that you guys provide that service, but what will be the questions that we should do for those clients?
As far as
That can help you guys, like, we
yeah.
don't send every person.
Well, first and foremost are they a wage earner, or are they self-employed?
Okay,
So knowing if they're self-employed right away helps us 150%. The next question, because let's say, and it's very common down here, there's a lot of truck drivers, a lot of trucking industry, in South Florida. And you ask them, are you self-employed? Yeah, I'm self-employed. Okay, great. How much do you make per year? And they tend to give you the gross number rather than the net number. Because when you are self-employed, we look at the net number. If you are a W-2 employee of somebody, we look at the gross number. So that's a huge
Yeah.
thing as well. So you want to ask them what their net income is if they are self-employed. And if they're not self-employed, oh no, I work at a hospital. Okay, well, how much do you make? What's your salary?
yeah,
If they have a salary of $80,000, we're going to use the salary of $80,000. So, stuff like that.
Buying time,
What do you mean?
like when they're looking to purchase.
yeah, that's the question.
Okay,
Because you got the plan, and sometimes
Yes.
they tell you, oh, they want to be in July, you know, and then you
Yes.
have to prepare them for, you know, to buy in July.
Yeah,
type of thing.
that's a good one too, yeah,
yes,
I mean,
right. So are they looking for something right now, or within the next 3 months, next 6 months? And that way we can, you know, another question would probably be, how's your credit?
yeah.
And when is the last time you ran it?
Mm,
Because
mm,
if they tell you that they just ran it 2 months ago at the car dealership, that they just bought a car, that's going to be a red flag, because a car purchase does lower your credit score 20, 30 points right away. And they probably shouldn't, if they were looking to buy a house, they probably should not have bought that car 2 months ago. They could have waited to do the house first and then the car. So
Me pasa mucho que están pagando el carro de otro. They are paying for another person
Yeah.
cars,
Yes.
or they are in another person debt, but they are
Yes.
not paying the car, and then we
Correct.
need to prove that money is going from another account,
yes,
and also the debts from school.
yes, those are the two things we see the most.
Can I get that one?
One borrower with 4 cars on their credit because each child has a car. And then the student loans, which he'll touch up on.
All right, so I've been dealing with that a lot lately because you deal with these guys who have lower incomes and are trying to get into the condos, and you got to get their DTI as low as possible to get into these loans and these properties. So in the situation for the cars, right? We have a guy we use who refinances the car payment. They can refinance it into another person's name or get them a lower payment if needed, if they got a higher interest. Like, for example, we had a client who got his car during COVID when the interest rates were skyrocketing, right? We got his car refinanced into another person's name and for a lower rate. And so that person is now a silent guarantor. He's still paying the car, right, at a lower interest rate, lower payment, and it doesn't come up on his credit. So now his DTI goes down. And then now for the student loans, you can do an income-based payment plan, right? So you go into, let's say, Nelnet. That was the one I did recently. Nelnet is the company that did the student loan for that person. So that person goes into the portal, Nelnet, applies for an income-based payment plan, and it will go from the $300, $400 they're paying per month to $2. It went to $2.67.
Yeah.
Wow.
Yeah, it was
Yeah.
ridiculous. Her DTI went, and then now she was approved.
And we can use, as long as they give you some kind of documentation that says this is your new payment based on your income. And under the Biden administration, they call it the SAFE Act, I don't know what. But under this is your new payment is $2.60 something cents. We will use $2.60 something cents. So there are ways to get those things off your credit, along with the car. So if you are just signing your credit for a relative, and they are paying that car, as long as you can prove that they have paid it for the last 12 months consecutively, we can take it off the debt to income ratios.
And if
So-
they have collections, will that department that refers the credit will help them to remove those collections if they are willing to pay those
Yeah.
amounts?
Yeah, collections, inquiries, all that stuff. Yeah.
And what about bancarrota?
I love the Spanglish we got going on here in Miami.
Okay, so unfortunately, bankruptcy is public record. When we do the background check right before underwriting, it will come out. Fannie Mae, Freddie Mac, FHA, they have strict guidelines from when the bankruptcy date was discharged. But FHA is probably the most lenient one with 2 years.
Yeah.
And you can still be in the payment process with your
Okay.
Chapter 11 or 13 or whatever it is. Yeah. So you can still be in the payment process with an FHA loan, which I believe if it's a Chapter 7 on conventional, it's 7 years or something like that, and Chapter 13 it might be 4, off the top of my head. But I have a little thing on my desk that tells me each of those dates, and I can get that information to you. But yeah, bankruptcy is probably the next question I would ask. Have you had any foreclosures or bankruptcies recently?
Those are bad.
Because they will come up.
Yeah.
And there are certain amount of years from those dates that we would need to require. But you can be one day out of bankruptcy or foreclosure, and we can do a non-QM,
Yeah.
and they're acceptable.
That's a good question.
The rate might be a little bit higher. Sí. But we let's say if you just filed for bankruptcy a few months ago and you were discharged, and we can do a non-QM with as little as 20% down. I mean, granted, your rate, it might be in the 10% or something like that. It might be a little bit higher, but we can still do it.
Then you have all the options. Then
Yeah.
when we receive a client, what would be the best way to communicate with you? Like an email, or is it the client
Send
number,
them-
email?
Yeah, a simple text is fine. You text us Saturday, Sunday, call us.
No, holiday, ya sabemos.
Holidays, yeah.
Yeah.
Hit me up. I got you.
I'll
call on Christmas. Merry Christmas.
There was
Get a
a
loan approval?
There was one of your clients that I was talking to on a Sunday. I forgot which one. I think it was even Maite. It was one of your clients. That's okay.
No, that's what we do. That's what we do.
Even me, every single day I'm fighting with underwriters, fighting with appraisers, and trying to help the process, which I think is which is actually the process timeline where we go from pre-approval to you looking for the home. And then we basically take care of the appraisal ordering, the title ordering, the underwriting, or we order insurances in-house. We'll work with the HOAs, the associations. We do all of that stuff. We have a team of processors, and that's all they do. And pound for pound, they do all of those things better than any other lender or bank. They all have enormous amount of experience as well. So none of our processors started yesterday or anything like that.
Yeah. And if,
So
and
they
if
know more
already-
than me.
no, our processors are second to none. They're the best in the business, right? So if they already come to you guys with a pre-approval, right? And they're saying, oh, we kind of want to shop around, you can actually just have them send a loan estimate to us with the credit score they used, and we can tell you how much your buyer can save with us. And if you guys want that return in business, save them the most money possible, right? Of course, and then all the way, hold their hand A to Z, all the way to closing time.
Also, another thing to add, I own the company 100%, so I make all the decisions in-house. I can beat anybody's rate, anybody's fees, anytime. So we will definitely make it happen. I was competing with it wasn't one, it was another real estate company. It was a client, but I was competing directly with Chase, and I was able to make it happen cheaper than Chase. They have these gimmicks where, oh, well, we'll give you back $7,500, or we'll give you back $5,000, but then they charge you points, and really all they're doing is offsetting the points. So I talked to the client myself, and I said, listen, I'm not going to tell you anything about giving you back anything. I'm going to give you my loan estimate. It had 0 points, 0 fees. We're going to waive our fees. We're going to do this. We're going to do that. I'm going to even cover your appraisal costs. And we were able to beat Chase by an eighth on the rate and the fees and everything and the closing costs. So their number was at least $1,500 less than Chase, and their rate was an eighth better. So
we steal clients from these companies all the time.
Yeah.
Rocket Mortgage, Chase, Flagstar, doesn't matter what it is, we're gonna steal a client.
Listen, when I see that a client is going to a traditional bank, I cringe. I literally do, because the person that they're talking to just takes the order, the application. They're not involved in the underwriting process. They don't have control. It's like snail mail. It's like snail processing. And I'm going through one right now, but we have no other choice because that's what the client chose. And now the client is getting frustrated, and I'm doing like, hello, what can we do? This is the lender you chose, so we're trying to work as best as we can with that lender.
Yeah, and even back when I used to work at the banks, in Bank of America, and I know them for a fact, that we used to have a phone at the end of the branch where, oh, you want a loan? Okay, use that red phone over there, and then you're talking to basically a glorified teller. It's somebody on the phone in North Carolina, and all they're doing is just going down a checklist, and then it goes into underwriting, and then the client is on their own, and they're calling a 1-800 number, and it's a different person every single time when they're checking up on their loan and for status and whatnot. So here we have personal service. So when you deal with Austin, you're gonna work with me also. You're gonna work with Dahlia. You're gonna work with Priscilla. So we have a team of people that are gonna be touching your file all the time, and you can call any one of us, and we'll all know exactly where that file is. So and Austin and these people will update you on a daily basis if you need to.
Personal service.
Yes,
Okay.
and there's the
And there
camp
we
right there.
are. And they're right here in Miami Lakes, a few blocks. Maybe one day we'll do a little caravan to visit your office.
Yeah, absolutely.
Okay,
Have some mimosas over there,
yes,
huh?
don't say it twice.
So listen, on March 20th, Realtor Night, let me know how many of you guys, if you guys want to go to the tennis open, so that we can get you guys.
I have to give you the list, yeah.
Okay.
I don't know who's a tennis lover.
Yeah, man.
You didn't know about this.
And go have some mimosas or some drinks, I don't know, tequila shots, whatever.
Quite, por favor.
My
Right,
favorite, so.
goodness, okay, this is a great class to know all the products, what sets First Origin mortgage lenders apart from other lenders, and I personally, I like that personal touch that they give. and that they're right here around the block, and we look forward to a lot of loans. And speaking of insurance, if you look at our calendar, Wednesday, I think the 20th, we're having an insurance company that you recommended
Oh, Gabriel.
coming in, yes,
Oh,
She
nice.
is?
to
Awesome.
talk about insurance. Because that's a
She's
big point
amazing.
for clients. We are all required to have insurance, one way or the other, even if it's a condo that carries own insurance, the client has to carry their part of the insurance for the contents.
If renters insurance.
And renters insurance, so on and so forth. So don't miss that class, okay? Well, great. So we're going to say goodbye to the group that's online and the group that's here. And let's stop the share. So you want to say bye to everybody
Yeah,
else?
absolutely.
Do we have any questions from the people that are online with us right now?
And remember, I know it's a lot of information to, withhold right now, but if you have any questions, you can contact us whenever. As I said, weekends and all, holidays included, all right?
Okay, we have it recorded that he said that. No,
Twice,
seriously.
a few times.
A few times, but they do answer their calls. Okay, thank you, and we look forward to seeing everybody next Wednesday, as always. So for now, ciao, ciao.